How to save a dying retirement plan part 2. All right, so we're going to go back to our scenario with John and Jane Florida, who moved from an expensive state to a lower cost state in Florida, 68 years old, and they're struggling. They're struggling to get by, trying to get an extra $500, $600, $700 a month to put them all up to the whole $3,000 a month, which they feel they can live comfortably on. And right now, they're nowhere near that. So let's dive right into it, part 2. So again, if you like what you see, subscribe down below, my friends, because we do a lot of topics here at the Heritage Wealth Planning YouTube channel. All right, so where we left off in part 1, we had a 36% probability rate, all right, and that's not going to get the job done because they're going to run out of money. There's just no other way around that. In fact, if we even go to cash flows, just to reiterate, you can see if we go to invested assets, right, their accounts, they run out of money. Here's their taxable account. It goes to zero and when they're 91 years old, and there's their Roth IRA and traditional IRA. They both go to zero at 95. Now, again, the likelihood of them both living until 95 is quite small because the husband doesn't seem to be doing great. He's not imminent or anything like that. The wife seems to be in really good shape, but the problem is, even here, is that if he dies early, she's going to lose her own Social Security. Now, they will reduce Medicare premiums and the Medigap that they have, so she will save $5,000 a year just from that alone. But she's going to lose $600 a month on her own Social Security. All right, so that's not a one-for-one replacement by any stretch. And I mean, at some point, you can only cut back so much when you're only living on $3,000 a month. So if one of those Social Securities goes away, we're in a world of hurt. No other way around that. So we got to do some serious work here. All right. So what can we do? All right. So we go back to the investments. And the first thing that I saw is that, hey, we got some, I don't want to go there. We have some money in this portfolio here. Could we annuitize it? A portion of the Vanguard, if not everything. Could we take an annuity, say for $100,000? And we could take $100,000 off this portfolio that generate roughly 6% distribution rate for both lives, and that's $500 a month. All right, so that would get us there. But the problem with that is it only leaves us with $28,000 here and another $40,000, about $40,000 or so. So basically $50,000 of liquid cash left over. So that's we could do that, but I want to kind of save that as an ace in the hole if we need to. So I'm not a big fan of that by any stretch of the imagination. All right, so what else can we do? Well, we can go to Social Security. All right, so what if we suspend Social Security for 2 years? Remember, they're 68 years old. In fact, I just need to go back here and change their date of birth because I want to put them right at the beginning of the year. 68. Yeah, there you go. That's good. Okay, so I want to make sure they're 68. They are. All right, so they're 68 years old. So they have 2 years before they hit 70. So what I want to do is I want to suspend their Social Security. All right. So what we're going to do is we're going to take their amount that they have now is 608 times 1.16. So for 2 more years, they'll get Social Security. So they're not going to get it for now until they hit 70, but for 2 more years, they'll get it. And it'll be 705. All right. Because we're going to suspend it, 705 for Jane. And we're going to say we're starting that and we're just going to leave it like that. Oops, we're gonna say take it at 70. Bear with me just a second. And I think I did want to leave it not at full retirement age. We're gonna say that would have had 550 before. So she should get 705 a month under my calculations, and he should get 1008 times 1.16. He should get 1169 at 11. Yeah, there you go. Okay, looks good at 70. So let's see what we have. It won't be that. Let's see. So I want to go back and see what their Social Security, if it's going to stop. In fact, when they suspend it and get it back again, what's their Social Security going to be? We're going to go to inflows. It's about right. Yep, 25,000 a year. So she'll get 1169 plus 7. What is she going to get? 700 something? And 705, I think. 184 times 12. Okay, that's about 25,000 a year. That's my that's right. I think that's right. Maybe just go back to the profile. Bear with me just a second, my friends, and because we're suspending Social Security, which means she will get 5. Oops, I don't think that was 5,000. Yeah, 726. There we go. 726 times 12. and he's going to get 8712, and he's going to get 1008 times 1.16. 1008 times 1.16 equals that times 12 times plus 8372. Yeah, so right around, okay, good. So that's right. This is going to be close. This might be a little bit higher than I like for this right here. So I'm going to, for Social Security, 25. I'm thinking more about 24,000. So I'm going to go back to his a little. Now, again, I don't know what the numbers are at the Social Security. So I told him, I said, go down to Social Security and see what they say. So I think what I'm going to do here is just reduce his to about 900. And because that should give us about 900, 1.32. That should be about right, I think. Let's double check. Retirement, cash flow, social inflows, Social Security. Yeah, that's about right. Okay, good. So that's what we want. And that might even be a little on the low end. Either way, I want to suspend Social Security for 2 years. All right. So the rest of 2018, and the drawback about this software is it doesn't give you the specific date. It just says in 2020, that's, at the beginning of 2020, they'll get their Social Security with their delayed earnings credit. So this won't be it'll be a little bit off. No other way around that. In fact, I don't even know exactly the numbers that they're going to get. But I told them, go down to Social Security and suspend it for 2 years. And that way we can boost our retirement income by that amount of Social Security, which is going to do two things. One, obviously, is going to give you those 8% year over year increases guaranteed with cost of living adjustments. And part two, when one of you all dies, the other spouse will get a bigger survivor benefit than what you had right now. So they agreed to do that. And that's a good thing. So doing that, what does that do to our retirement? It takes it from 36 to 60, that alone. All right. So we've already gone a good way into making this last a little bit longer because we're saying we want to make sure that they get Social Security. Now, what does that do for their income? Well, they still need, basically $72,000 minus. So they need $36,000 a year, but they only have $8,400 come from Social Security. So they need $36,000 a year. I mean, not from Social Security, from their annuity. So they still need $27,000 a year times 2 to make up the difference. So they need $55,000 in cash. So what we're going to do is we're going to go back to their net worth. All right, because they're not getting Social Security for now in 2 years. And again, don't let the numbers exactly on the system I just showed you, because we're going from October 2018 to October 2020. And the software just does it year over year. It doesn't quite give us the half years or 10 months into the year. So we're just saying 2 years. In reality here, we need 2 years of cash to cover that we're not getting Social Security. That means we need $55,200 of cash. Now, again, in this variable annuity, we already have $15,800. All right. So now what we're going to do is we're going to make the IRA. We're going to make that all cash too. So we're just going to say $20,000 here. All right. So that we're going to say that, and then we're going to get rid of this right here. All right. So now we got $35,000 of cash, and now we're going to go in here. And we need 35,000 minus 35,000. So now we need 20,000 of cash down here in the Life Strategy Growth Fund to cover those 2 years. So now what we're going to do is we need 128,000. So let's just say we're going to have a nice even, we're going to put 28,000 in here. Why am I doing this? Because I do not want them to have to sell the market if the market falls off a cliff. In the last couple of days, we've seen some pretty good falls, even though the couple of days before that, we see some pretty good gains. So it just is a wash. But either way, we can't risk it. We need that money to be there. 34.23. 2,921 shares, get rid of that. 2,921 shares is what they got. 2,921 shares. Okay, good. And that should leave us, $100,000. All right. So what we're doing here now is we're saying in our cash flow scenario, for the next 2 years, they're not going to have any money coming in except for their guaranteed annuity. Now, you saw that change a little bit. Don't worry. I'll show you something. They have no income. They have $84,000 coming in solely from their annuity, right? So that's all they got. On top of that, we have to put some money in cash to cover the fact that they have no other money coming in except for that annuity. And so what we're going to see here is income flows. We don't have anything other than the annuity. Now, I don't know if it'll say it won't. So what we got to show you is withdrawal from accounts. And you can see they're going to take that right there from the taxable account for 2 years running. All right. So we're going to take to make up the difference, we're going to take it from the taxable account for both those years alone. All right. So now we got 2 years of cash covered and we got an annuity to make up the difference. So at least for the next 2 years are fine while we're waiting on Social Security to kick in. Now, and I just want to double check on cash flows, income flows with Social Security. There we go. All right. Now, I did see something that might kind of stress you out a little bit that changed the plan quite a bit. Notice that it went from 36 to 60 to 18. And the reason for that is because we don't have as much in investments. So first thing I got to do is double check to make sure our investments are still lined up like we want. And it is. We got rid of the holding. Okay, and that's not good. Wait, we're right there. We got rid of the cash. So we want that to be in cash. We put $28,000 in cash there. So we don't want that. Oops, blink. All right, good. So that should be 130. Yeah, 127. Okay, good. So somehow I didn't hit save. So always got to hit save. Lesson for the silly. You got to hit save or else you're going to be in a world hurt. So let's see what that changes for the retirement plan scenario. It should jump up quite a bit. Well, not that much. So now we're still like, what are we going to do? And here's where the second part of this comes in. So the next 2 years are good to go, but still we need to have some cash flow coming in because our invested assets simply will not give us enough. They're still going to run out of money without question because we're going to pull money out. So what do we do? Well, in fact, what I would suggest, actually, what we need to do is we need to change the analysis to pro rata. And where does that do that from income? I forgot where I do that. All right. Where do I do that? I got to change the income coming. Is it from tax? I think it is from tax. Bear with me just a second, my friends. Distributions. And we go down to sequential. We want pro rata. All right. That shouldn't change much. But the point about that is the computer's just pulling it from the taxable account. And I want to come from the annuities. Then I want to come from the IRA. Then I want it to come from the taxable account. All right. So now what else do we do? Well, now we got to change something else. Now we got to add another source of income, and we can do that by taking a reverse mortgage. So watch this. So we have what we can easily do is we say, and I already ran the numbers on a video I did yesterday where I did a reverse mortgage on some of the $130,000 of fair market value on their home. Again, the appraised value, not the assessed value, the appraised value. And we're able to generate about $300 a month in income for what's called a 10-year payment for the rest of their life. And so we're going to do the same thing here, and we're going to call this other income. Oops. And that's $300 a month, which would be $3,600 a year. And we're going to start in this year is owned. Now, the interest is tax-free because with a reverse mortgage, you don't pay income tax on the money you get out. You just don't. This is one of the benefits of it is your return of principal. So now let's go back here. And now we're going to go back to retirement, and it goes up to 72%. Very simple. All right, so what we've done here, all right, so we've done a lot of finagling. I get that, but a couple of things happening. We solved the issue, and again, if we can get 72%, I'm fine. The reason I'm fine because anytime I can get over 70, given the fact that the likelihood that both people live until they're 95 is probably not going to happen, but they wanted me to plan for both to live till 95. Now, watch what happens with a couple of things. Let me back up. So what we've done here is we've suspended Social Security so we can get those 8% delayed earnings credits for the next 2 years. That's a big flipping deal, a big deal, all right, because it's guaranteed. It has a cost of living adjustment. It's the best annuity you can buy, bar none. And you need to do that. Number two is we reposition our portfolio to have a big cash holding to cover those 2 years while we're waiting on Social Security to kick back in. Oh, by the way, you can suspend your Social Security. That is correct. You can't withdraw your application and then pay it back. Those days are gone. I can't do that anymore. You can do it if it's in the first 12 months of taking Social Security, but you can suspend it. If you took it at 62, now you're 66, like I wish I would not have taken it at 62, you can suspend it and you will get those 8% each and every year delayed earnings credits. That's a fact. Now, you're not going to make any money between now and when Social Security kicks back in, which is why we had to reposition their portfolio to generate enough cash that they could take out all the while they're waiting on Social Security to kick in. But you saw what happened. That's going to make their probability of success drop significantly. But what are we going to do? Well, we're going to take the equity in their home and use that as an income source. And I'm just telling you, the idea that Dave Ramsey said that's a scam is crazy, because the alternative is to take a home equity loan. No one's going to loan money to somebody for a $100,000 home equity line of credit if all they have for income is $2,500 a month. That's not going to happen, my friends. So you go now, a home equity with a reverse mortgage, a home equity conversion mortgage, a HECM, is going to cost 2% of the the appraised value, not the assessed value. Assessed value is what the county has on it, which has nothing to do a lot of times with the appraised value. So it's going to cost them $3,000 right out the gate to take that reverse mortgage. We want to not have an origination fee. Maybe even I put $1,000 as the origination fee just to get the mortgage guy to get him paid. And then we're doing the lender's margin. All right. So the lender's margin is the current rate. So at the end of the day, it's about 5.5%. That doesn't bother me, though. All right. So what's going to cost about $6,100 in closing costs, which we can finance into the loan. We don't have to pay that back. $6,100. It's $3,000 from your mortgage closing, or from your what's called the mortgage insurance. So that way, if you die and the loan is worth more than the home, the government kicks in to cover you, makes you whole, which is what you want. You don't want to leave a debt to your kids. So what we do is 2% of the appraised value. In this case, the appraised value is $150,000. It's $3,000 for mortgage insurance. It's about another $1,500 to $200 or $2,000 in terms of the title. I hate that title work. It's such a silly scam, in my opinion, but it is what it is. The appraisal is going to come on you. The faxing, they always got to cost money to fax from point A to point B. You're going to have to pay to write, to sign the closing docs. You got to pay for the pencil in which to do that. It's crazy. And then, of course, the origination fee. So in this case, it's $6,100 of closing cost, which I don't want them to finance out of pocket. I want them to put on the loan. Absolutely. And that'll generate about $300 a month for the rest of their lives. Husband dies tomorrow, $300 a month still for Miss Jane. Now, those are the three things we've done. Now, watch. I want to show you something, though. Let's go to tax. All right, so they have no tax bracket, none whatsoever. In fact, if we go to 1040, we'll see why. In fact, let's go to 1040 for 2022, because that's when Social Security kicks back in. They have a small amount of tax-exempt interest. It doesn't matter. They have a pension annuity at $8,400. Now, notice you're not seeing something in here. So they got their annuity, their SPIA, at $8,400. They got a small capital gain. A capital loss won't matter because they have no taxable income. So this is their AGI. What is not showing up on there? Social Security and something else? The HECM, the reverse mortgage, is not showing up on there. So they have $11,097 of AGI, no taxable income because they have itemized deductions of not itemized standard deductions, $28,000. So they got no taxable income whatsoever. So they pay no tax. Now, given that their AGI is $11,000 and their taxable income is zero, I wonder if that means they can qualify for Medicaid. Medicaid. They got $24,700 of Social Security, $8,400 in pensions and annuities, which is a SPIA, plus another $3,600 in this case in their home equity line of, not the home equity line of credit, their reverse mortgage, and they have no taxable income and only $11,000 of adjusted gross income. They are in the poverty level, and I don't know exactly what a poverty level is for a married couple filing jointly with no kids, but if that ain't it, I don't know what it is. And so they should be able to qualify for Medicaid. Now, if they were able to do that, and we can go back here and eliminate some of their expenses, where was the expenses? Right here. Or goals, health costs. So let's just say we can eliminate their health cost, and we'll just say it's $1,000 each. I mean, I don't know. I don't know if this can happen or not, but my goodness, Medicaid is for poor people. And if you're only making $11,000 as gross income, I think that would qualify. So let's go to your retirement cash flow or your retirement analysis, and we just eliminate. Yeah, now we're at 100%. All right, so that they paid taxes their whole lives working. In fact, the husband, Mr. John here, was going to work at Walmart for $10,000 a year just to greet people so they can make an extra bit of money. But he can't stand up anymore that long. He's not in good shape, and he can't stand up, and his hearing is poor. And so at the end of the day, he can't do that even though he wanted to. Now, these people have worked their whole lives, and they're trying to take care of their kids. So don't tell me now these people are welfare mamas or something like that. No, they're not. They're poor. They have a home, and they got Medicare, which they paid for. They got Social Security, which they paid for. They both paid into the system. They just had some bad planning and some bad advice, and they still, even in this case, I'm sorry. If we can't afford to make sure that these people are freaking somewhat honorably taken care of, then the society, as I know, is just kaput. This is not some freaking person living high off crab legs and filet mignon while they're on EBT cards. That's not the case. So I'm telling you right now, some people say, Medicaid, you're taking advantage of. No, Medicaid is exactly for these people. The people taking advantage of Medicaid are people trying to hide their assets so they can give it to their kids so their kids can live large, knowing full well that they have hidden their assets, and now so they can qualify for Medicaid. And there's lots of attorneys out there who'll show you how to do that. And that is what's wrong. Hiding your assets to qualify for Medicaid, essentially giving your assets to your children so they can live large while you qualify for Medicaid on the backs of people like these who paid into it. All right, so it's a three-pronged process. Suspend Social Security, take it back at 70. Review your portfolio to make sure you got enough cash flow as cash to cover taking Social Security, to cover while you're waiting to take Social Security. You got to have enough cash to make up the difference for when you're not going to take Social Security, because we do not want you drawing it from an investment portfolio that can fall off a cliff. All right, you can't have that. And number three, take a reverse mortgage, man. There's $6 trillion of home equity out there in the U.S. Take a reverse mortgage, for heaven's sake. It will make your retirement plan solid. It will. Not for everybody. I'm telling you right now, it won't. Take the flipping reverse mortgage. I'm going to do a lot more on reverse mortgages because that has been new to me, and I cannot believe I missed it for all these years. People freaking out at night because the markets, they can't sleep, and they have a couple $100,000 in equity they could tap into. Take a reverse mortgage. In this case, if you're this poor, go and qualify for Medicaid, because Medicaid will pay your Part B and Part B premiums, Part B and Part D. And I think it even pays your Medigap as well. Now, you might still have copays and stuff. I don't know how it works, but I know it pays your Part B, Part D, and I think it even pays your Medigap. Now, don't quote me on that. Either way, if we can save a couple extra $100 a month on Medicare because Medicaid is helping us, why would you not do that? Now, again, if you're living high in the hog, light cigars with $100 bills, don't do this. You should pay. I'm sorry. If you've got the assets, you've been blessed with assets, the financial well-being, you should pay for it for sure. I know you pay taxes. I know you have. Well, so haven't these people too. And they're only going to live off $3,000 a month. All right, so I hope this helps. So again, the 3 ones: suspend Social Security, redo your portfolio so you have enough cash. I guess it's 4. Redo your portfolio so you got enough cash you can draw into without drawing a portfolio that's fallen on hard times like 2007, 8, and then 2009. Do a reverse mortgage, absolutely. And then if you can qualify, see if you can get on Medicaid as opposed to Medicare. And that, my friends, is how you save a failing retirement plan. So if you like what you see here, subscribe below. Comments are always welcome for sure. Comment, thumbs up. We'd love to hear your thoughts on this. And we'll see you next time at Heritage Wealth Planning YouTube channel. Thanks now.